Folks, we are going to talk about the banking sector. We're going to talk about SVB. We're going to talk about Signature Bank. We're going to talk about regional banks. We're going to talk about the big banks. In order to do this, I got to bring on my Wall Street veteran, Taylor from Life Goal Investments, man. You and I have been texting over the weekend. It was wild, man.
Oh
What's
my
going
God.
on?
Oh my gosh. Oh my gosh. There's been reversals in the banking sector. The government hasn't been super clear about bailouts and whether they're coming, and then they come and it's there, the bailout's there. So we could talk about that. It's a little different than 2008, but it is madness in the banking sector right now. I think, the Fed rate hikes are coming home to roost right now and
Yeah, I mean,
crushing banks, and we could talk about it for sure.
Yeah, I mean, one of the things that I think was a talk track for a year, and I think you and I have hit it, is the Fed is very likely going to be raising rates until one of two things happen. One, they defeat inflation, which was everyone's hope. But we always had this little caveat, or they break something. And I got to ask you, was Silicon Valley Bank, Signature Bank, what's going on in regional banks, is that a sign that the
Yeah. So
dreaded something broke?
let's talk about kind of the two underlying problems that banks have right now. So they're both a
Perfect.
result of the Fed meaningfully taking rates higher. But think about this, like banks have two primary drivers of income. One is their loans that they put out, and the
Mhm.
second one is their investment portfolio that they have as well.
Yep.
Both sides of that are coming under absolutely massive pressure by the Fed.
Yep.
So you look at kind of Silicon Valley. Silicon Valley is a unique one. So I'll just focus on broad-based banks in general right
Sure.
now. If you look at loan growth in loan applications, it has fallen off an absolute cliff since the
Yeah,
beginning
we,
of
we talk
2021.
about it on my channel every Wednesday. Loan originations are down, roughly speaking. Purchase 48, refi 74. That's a revenue stream that's not working.
Correct, correct. So when you deposit money in a bank, they pay you 0.01%. They either want to take that money, ideally, and put it towards a loan
Yeah.
and loan someone out and get, 6, 7% return on that loan.
Mhm.
Or if the loan demand isn't there, which it's not right there, now they take money out and they invest it in treasury bonds or
Yeah.
mortgage-backed securities. And they capture that 5 to 6% yield on that bond and take the difference between that and what they pay you, which is 0.01%. And that's
Mhm.
perfectly fine so long as withdrawals aren't overwhelming. And so
Exactly.
Silicon Valley Bank is in a unique scenario because they are at the epicenter of the tech crunch that's currently taking place. And so
Mhm.
therefore their client base was withdrawing significantly more than they were depositing. And because of that, it forces them into a situation where they have to sell bonds over the last year. As the Fed meaningfully takes rates higher, what happens to bond prices? They come screaming down on the other side. And this
Yeah.
bank specifically mismanaged their liquidity risk terribly because
Oh,
they
their
didn't.
interest rate risk is horrible. They had 0% of it hedged.
It's
I mean,
it's it's
somebody's
nuts.
going to jail.
Oh yeah, I mean, and this is something that all of a sudden the sound bells were alarmed on Thursday late in the day when they said, "Hey, we're going to issue another round of financing through issuing equity to the market." And the market said, "Whoa, whoa, whoa, time out. No one's giving you funding for equity right now. We can see
Yeah.
your loan portfolio is
Yeah.
debunked, and we can see your liquidity profile is terrible, and you can't meet the withdrawals. You're insolvent."
Yeah, you're insolvent. And then I don't know. I mean, if basically in the valley, which is where I live and much of my network is, there were Discord groups and Twitter and this and that and the other from CEOs of private companies saying, get out.
Yep.
And I have to say this again, not even the great and almighty JP Morgan could stand a 24-hour window where 20% of their deposits leave.
Yep. Yep.
It's a
You're exactly right.
classic
Yeah,
bank
it's a
run.
bank run. It's a bank run. I think
It
that it
is.
was, and you correct me, you might know better, but the numbers I saw, there was $172 billion worth of deposits on their books coming into this year. 42 billion of
Yep.
it left on Thursday in that bank run.
Yeah. Yeah. I was looking at their balance. How I got to 20% was
That's about right on those
yeah.
numbers. I mean,
Yeah, the value of it was this or that. But anyways, no bank, because that's not how they're structured, right? They don't keep 20% liquid, right? They keep 5 to 7% liquid. So Silicon Valley Bank had a lot of problems. But what happened once that Twitter group or Discord group or whatever happened, and you had Founders Fund, Peter Thiel, and others say, get out today, cancel meetings, cancel clients, go, go, go. Game was over.
Yeah.
is over.
And now, so the FDIC steps in and seizes all bank assets. The Federal Depository Insurance Corporation seizes all bank assets. They have historically said, we will insure anything up to $250,000. 97% of the assets on the balance sheet of Silicon Valley Bank were in accounts that had over $250,000. So people up until yesterday were saying, what the hell is going to happen to all these assets? Am I going to be able to get this money out of this bank or not?
Can I make payroll? Can I do this? Because this is operating capital, right? So
Correct.
again, so again, yesterday afternoon, which was Sunday, I guess evening Eastern, they basically said money good, all's fine, access Monday morning. So that's behind us. I actually want to talk about a bigger problem that actually the FDIC pointed out in a very quiet press release. I think it was 2 weeks ago. And that is that banks in totality, they were very clear not to call out any individual banks, as the FDIC should, had $680 billion in unrealized losses. This is the whole mark to market versus carry to duration. And basically what a lot of banks have is they had an influx of capital for 2 years. They did what the Fed wanted and bought treasuries. They unfortunately went out on the duration curve, and now they're caught.
Yep.
And that's really what we're suffering through.
This isn't really all that different, honestly, than what you look at in 2008. I mean, it's a different asset that caused it, but the marking to market, when you have to take your assets or investments in these bonds and mark them to current price because you're getting forced to withdraw and sell them into the market. That's exactly what happened in 2008. It was just mortgages packaged in 2008 where people said, these mortgage bonds, they have a value, or these mortgages have a value of $1 million. When the housing market goes to hell in a handbasket, like the bond market did over the last year, they then re-rack those numbers down to what current market value is as they have to sell them back into the market. Yeah. And all of a sudden that investment portfolio for the bank explodes.
Yeah. So again, one of the things that was very subtle in the address yesterday is I guess it's the Treasury or it's the Fed. I don't know which organization, but one of them has a discount window. They're now going to take these bonds that by my math are down 25 and some 35%, but they're going to give the cash at par because they can hold it to duration.
Correct. Yeah. So they'll exchange. Exactly. They will essentially likely be made close to whole at the end of the day because they will hold onto those bonds and let them mature, but they're going to provide liquidity in the meantime and pay that out at par. Correctly. Right. And so go ahead.
So again, that was a subtle thing that I don't think the average person understands. That is, again, de-stressing the situation. Instead of marking the market at 67 cents, your balance sheet shows a hole, you're insolvent like SVB. They're going to say, give us this crap. We will give you 100 cents on the dollar and you can have the cash. Your money good.
Correct.
That's happening right now.
Correct. And it was interesting because yesterday morning, Janet Yellen on CBS's Face the Nation came out and said, we're not bailing them out. And she didn't provide much clarity as to what that meant. And then later on the day, what they said is they want to make the depositors fully, whole or
money
essentially
good. Yep.
Money good. Exactly right. So now this is not the same bailout that we saw in 2008.
No, very, very different. But it is I want to be clear. This is a bailout.
Oh, I 100% agree. You can't put that any other way.
No, under the rules of the game that existed last week, the people over 250K knew about it. This FDIC thing was not a secret. It was not a secret.
Correct.
So they were all at risk, and they all knew it, whether they want to admit it or not. Once you go in and say they were 100% good, it was a bailout. And I don't know if here's my thoughts on SVB. I thought they would be bought by Sunday, 6 o'clock Pacific, right?
Yep.
Near as I can tell, they're not bought. One piece was cut off in Europe for a freaking pound. £1. That's $1.21. So if you're going to tell me that Silicon Valley Bank's balance sheet is anywhere close to $187 billion, you're smoking crack.
Yep. Totally
Somebody's taking a loss.
Totally agree. This also happened in Texas in 2015. In 2015 happened in Texas in the Houston area to a couple regional banks there that were extremely exposed to oil. And gas prices, if you remember in 2015, came shooting downwards. There was actually negative. I won't go into that. Anyway, gas prices came screaming downward, oil prices came screaming downward, and these banks that were really exposed to the oil market had the exact same situation play out that Silicon Valley Bank had, to a slight lesser degree. They didn't have to get bailed out, but the share prices came flying down, and they thought they were going to have an insolvency situation there that was narrowly avoided.
Yeah. One of the things I would ask you to look at, because again, you've been on Wall Street for 10 years. Were you even born in 81?
Nope, I'm an 88 kid.
88 kid. So one of the things I would ask you to research, and this is something I did over the weekend for my channel, is I think what we're going through is very much like the S&L crisis. If you go back and look at the root of the S&L crisis, it was basically driven by the Fed taking rates up at an extraordinary rates, obviously higher, but fast nonetheless. And there was a mismatch of duration and yield. And unfortunately, the Great Recession, the Lehman moment, it was an event. It was painful, but it was one. The S&L crisis was a 10-year decade of, the nearest analogy I can have was cars piling up in fog, right? First, there's 2 cars that hit, then the third one comes, then the fourth one comes. So I do not expect this to be quick. This could be years, because we have interest rate duration mix. We have balance sheet holes. And one of the cures for this is just time.
Yeah, it really is. I mean, I think I already stated this. I was talking about it before, so I don't know if it was on this session or not, but the KRE, the regional sector bank ETF, is down 15% today, and it got torched on Friday as well. So this is
an additional 15%.
Correct. Right. So this isn't something where the market's not reacting like this is the last thing that's going to happen here.
Yeah.
This is not playing out the way.
I mean, the one that we should talk about, it's at least, I think it was halted last time I checked. It was down 60%, was First Republic Bank. I have no interest in it. I have no positions. I won't, because I'm talking about it. But the market is saying something's going on. And this is after the Fed gave him money. JP Morgan gave him money,
yeah.
Right? There's going to be some forced marriages.
That's exactly what's going to happen. And probably a JP Morgan, Goldman Sachs, Bank of America, they could come out on top on this and end up being winners at the end of the day, as they buy things for pennies on a dollar and say, listen, you guys are insolvent. We'll step in here and take out all of your issues. You don't have an option. We'll pay you whatever we want to pay you for. The only competition,
we'll pay you £1.
Right. The only competition is your only other buyer that's in the market. That's the only competition, because you don't have a choice but to, you're going to be forced to sell.
Yeah, there's going to be this. That is actually an interesting question. So obviously, we also had in New York, I don't know if people realize this, we had a another bank closure or seizure, Signature. And what a lot of people don't realize, again, Signature Bank is not one I ever heard of, but it now goes down as the 3rd largest bank failure, behind Washington Mutual and behind SVB. This is not a small bank. Signature, 110 billion, I think.
I've been putting out a lot of content. I put out probably 4 or 5 videos on social media about this, kind of explaining what's going on in real time, et cetera. And the response is very Pollyannish by the people. They're saying, listen, this isn't a big deal. This is one bank in Silicon Valley. It was very unique. And you look at it today, and again, I'll go back to the market. The market generally isn't wrong or offsides by that much. And the regional banks are down 15% today. Like, this isn't one bank. Now it's 2 banks. It would have been a 3rd bank if JP Morgan didn't step in with First Republic.
Oh, it would have happened today. Yeah.
Yeah. So you can look at this and say, okay, we're all good. But in my opinion, good luck with that theory, because look at what the market's doing right now. It's eviscerating regional banks.
Yeah. I don't know. I obviously we're talking live, so I don't know what's going on right now, but let's just talk about what's happening at the human level, because a lot of economics, the more you're in it, it's human behavior.
Yep.
So what I see going on right now is, you're a small business and you're at one of your local banks because they gave you your small business line. They gave you this, they gave you that. You're loyal. Now you're like, well, loyalty's out the window. I got to make sure I can keep going. Even with all this bailout, all of these assurances, you're at your bank today going, sorry, guys, wire this to JP Morgan, wire this to Bank of America. I don't care, because there's no risk. There's no risk to move.
Correct.
So you're seeing this huge vacuum, this sucking sound out of the regional banks.
Yeah. And say you have $8 million and you're a small business, you have $8 million in deposits.
Sure.
At a $250,000 clip, are you really going to go out and put that in, what is that, 32 different banks?
No
You're not
chance.
going to do that. You're not going to do that. So that's why the regional banks are facing the most pressure, because JP Morgan is absolutely systemically important to this
It's
country.
one of the
If
big four.
JP
It's not
Morgan,
going anywhere.
yeah, if they were to fail, they would be backed. And now granted, like, regional banks are getting backed right now too. But if this were to really go south, your money is much safer in JP Morgan than it is in some regional bank. And that's why, the regional banks are just getting torched today.
Yeah, I mean, and then the last thing, we'll wrap this one up, is if you are a private company, right, you have any kind of funding, it's now board level. There will be a board level risk mandate that says you must be at the big four. You're not going to be able, I mean, it will be a board level decision. It will be limited partners, you know.
I totally agree. So last thing I'll say on this too is, like, you can't fault the people that had their money in Silicon Valley Bank. They don't have the ability nor the time, whatever it is,
Oh,
to
no, they're
go
not
in and
looking at their
analyze
balance
the
sheet.
bond.
No.
Yeah, the bond position. They don't have the ability to do that. They weren't at fault. They were any person that has money in a regional bank right now over $250,000. So it's not like they could have seen this pitch coming. Now, granted, the executives absolutely did. They did for sure. The executives of this bank knew this was coming. But no, they couldn't see this coming. They weren't at fault here, and nor is anybody else with money in regional banks at this point. But this is absolutely the alarm bell that's going to cause them, to your point, to start taking this money to bigger banks.
Yeah, so this banking crisis is not over. This is going to be a slow moving car wreck. I think at the end of the day, the big get bigger. Second, I think deposits. I don't think anybody loses a penny in deposits, which is net positive. But at the end of the day, consumer psychology has changed. The people will be at big banks. Small banks will, regional banks will be hurt, and there will be less of them. So at the end of the day, Taylor, you put out amazing content in real time about real issues. How can they follow you?
Yep. Follow us on one of the two platforms, Instagram or TikTok, or both. We do a little different stuff on both of them, and it's at Life Goal Investments.
Thanks, buddy.